Now it's time for our panel discussion, moderated by Charles Bovaird. Charles is Vice President of Content of Quantum Economics and a senior contributor for Forbes. The panel will discuss DeFi through the lens of investors looking for opportunities and the pitfalls in this compelling area. On the panel today is Hans Koning, Chair of the Digibyte Foundation, Carolyn Reckhow, Head of Business Strategy at Keep, a network that provides a bridge between public blockchains and private data, Piers Ridyard, a serial entrepreneur and the CEO of Radix, the first Layer 1 protocol for the DeFi industry, and Santiago Roel, partner at ParaFi Capital, a San Francisco-based alternative investment firm focused on blockchain and decentralized financial markets. Over to Charles.
Can the panelists hear me?
Yeah.
Okay. So would you like me to repeat the question, or do you have it right in front of you, or would somebody like to hop in?
I did not hear the question.
Okay. Sorry about that. Okay, so I'll repeat the question. What are the most important things investors should know about opportunities in the DeFi space?
I mean, for me, it really depends on level of sophistication. There's sort of huge number of layers to buying into the DeFi space or just allocating capital to the DeFi space. It comes down to a lot of the same fundamentals you would if you're allocating capital anywhere, like team, technology, and what the product is actually addressing, like what the need the product is addressing, and whether or not it's addressing it in a sensible fashion. But there's all of these extra things that happen within the DeFi industry, in that capital moves very, very quickly, often into and out of projects very, very quickly. And there's a load of things that happen with bots and the way that you actually buy into and out of projects. That means that you can end up getting front run and things like that, which means that if you want to be doing high frequency DeFi, or you want to be moving quickly, then you're going to have to understand a lot more about how the code works than if you're just going, well, I'm going to put some money in here and leave it for 6 months or a year. And there's sort of like this massive gradient between having to really, really understand the underpinnings and really easy to use things, like sort of easy to use like Aave and Compound and things like that, to sort of things like YFI or YAM, which it sort of has all of these risks that I'm sure we're going to talk about when it comes to hacks and unaudited code and all that kind of stuff. So like, I think for me, the first thing is just pick your level of sophistication. How comfortable are you with crypto in general? And then start from there.
Okay, yeah, that sounds perfectly reasonable. Would anybody like to add to that?
Yeah, I think it's very important to sort of start at the basis. You need to understand what blockchain is. You need to understand what finance is, and that if you know those two, that doesn't necessarily mean that you understand DeFi. I know it sounds a bit cryptic and it sounds a bit weird, but it actually is. You need to understand that DeFi is a new and a bit of a different kid on the block in that sense in the blockchain space. I think it's very important also that you understand what kind of services it can actually offer. What is the benefit? What is the use DeFi can actually bring to you? And I think automated market makers, collateralized lending, or interoperability are a couple of things that are very important and brought to the center stage all of a sudden by DeFi. And you need to have a good understanding of what that actually is and how you can use it. And I not necessarily want to belittle people, on the contrary, because we're all learning. Trust me, so am I. But you do need to understand that you simply can't run into it. You need to be able to walk before you can run. And tempting as it might be, and definitely looking at certain results that have been achieved in the bull run we saw last summer in the DeFi space. If you jump in now, that will not necessarily be the outcome for you. So, there is always a caveat, I would say, but that's also an issue and a topic I'm sure we'll touch on later on.
I can jump in here. I think it's important for this question to talk about the definition of DeFi. DeFi is the idea that you can assemble the elements of an economy, design them to function properly without the need for a centralized authority. So Bitcoin was the original DeFi, in my opinion, and the term itself is new. And I think the whole ecosystem, crypto ecosystem, is benefiting from solidifying concepts around the term, and concepts that became popular in concept with these real financial products that started cropping up specifically on Ethereum. When you look at projects like MakerDAO being one of the first ones, and then other things like Compound and automatic market makers that people have mentioned. But really, I think the real significance in DeFi and these new projects is around avoiding centralization. So that means individuals can avoid surveillance, censorship, avoid their funds being lost or stolen, market manipulation. It's really just about financial freedom.
I would actually disagree with part of that definition. I don't think that's wholly accurate. Like there are plenty of examples where there are nexuses of control in decentralized finance applications. Take any of the top ones, Compound, Aave, etc. For me, the thing that's making DeFi exciting and popular for people is that you have that it's essentially interoperable, frictionless interoperable finance. I have 3 applications: Uniswap, Compound, and MakerDAO, and I can compose them all together to create another financial product, or to be able to arbitrage between them in a single block. Like, that's what's making DeFi, in my opinion, that's what's making DeFi fly. It's not like the concept of decentralization and anti-fragility, I think, underpins the idea of crypto or public ledger technology. But for me, for DeFi, it's much more about this ability to move money very quickly between multiple different projects that are made by competing teams that create these incredibly interesting and exciting financial products that look similar in some ways and then very different in others to traditional financial products.
Yeah,
I agree. Money, decentralized money is important. Decentralization is important, but I wouldn't say that that's part of the core definition of DeFi, at least for me.
I don't disagree with that at all, Piers. To clarify, I guess when I spoke about centralization, that is more something that I think investors should be looking at when evaluating projects. That's definitely, it's a huge risk factor. But agree, there's a lot of projects flying around right now that have these locus of centralization.
Yeah, I mean, just to add in here, at ParaFi, all we do is invest in decentralized finance protocols, and I guess when we explain DeFi to bankers or venture capitalists or whatever, it's like, well, what if you had perfectly auditable collateral 24/7, 365, and I think that's people start getting really excited about that, right? And so a lot of what has been done to date is replicate systems of the economy, to Carolyn's point, that exist in Wall Street, and porting them over to DeFi and what Piers was saying, in a highly composable integrated system. I think we can all agree here that finance just hasn't caught up with the internet. There's a very obvious reason for that. You can't move money the same way that you move information through packets. You need a central authority. So, I think we'll get there. I mean, it's not a perfect system by any stretch of the imagination. These things take time, and there are certainly a lot of risks, but there are early indications, and it's quite promising how the system just works, and it's very anti-fragile in some respects. It's not for everyone, I'd say, and so we're very early still, and so there are plenty of risks. So just buyer beware.
Reasonable plan. I mean, I suppose other terms you could put in there besides buyer beware is do your own research. That seems to be buyer beware is probably a little bit more old school than do your own research. DYOR seems like something that's pretty widespread in the crypto space. So
yeah, exactly.
Yeah. Okay, so for the next question we have, what do you think are the biggest potential pitfalls that investors interested in DeFi need to watch out for?
I mean, like, numerous and varied. Like, the smart contract audits are massively important. in the Ethereum ecosystem. I mean, it's one of the key reasons that we built Radix in the first place, was because the way that people build decentralized finance at the moment is massively insecure. And as a result, you need this whole extra infrastructure. You build the application, but then because it's built in Solidity and because of how Ethereum is built and it's like very insecure in how it deals with all of these input outputs and all this kind of stuff, it then needs to be passed to a specialist security firm who then goes and makes sure that but there can't be bugs in the code and there can't be problems that cause all of these things like recursion issues that end up in funds being lost. And that's happened time and time again. Like we've had, recently DForce, we had Yam.finance, which had like 500 million come in and then 500 million flow out again, like within 48 hours. And so there's this really difficult thing that every developer, people who want to build decentralized finance wants to do is there's an opportunity. I want to build code really quickly, but I can't. I've got to then go and get it audited. And so you're seeing at the moment all of these developers just putting out code that hasn't been audited, that people are just YOLOing money in, and things go south, things go wrong. So like I'd say the biggest thing for me in terms of a checkpoint is, has this been audited by someone that's a legitimate company? If you're thinking about actually putting some money in there and leaving it in there for a long time and not wanting to be sort of constantly checking to see if has there been a hack in the last hour. So that's my number one pitfall that you want to watch out for if you're going to put money into anything once you've done your research.
Okay. Adding on to that, for me, the number one would be trust. And I think financial system, blockchain technology stands and falls with trust. And I just saw a comment of the word rug pull, and the sort of that reminded me of the word trust. I think trust should be key in basically anything. And without trust, there cannot be a system in DeFi. That comes back to auditing the smart contracts. That comes back to doing your own research. Fundamentally, for me, it's trust. And the issue sometimes with trust is that we think we have blockchain, so therefore we have trustless trust. Well, that is definitely something you need to rethink again. You can't just jump in because it's blockchain. So for me, trust would be the number one issue.
Fair enough. Yeah, that sounds perfectly reasonable. I mean, the entire financial system is at least supposed to be based around trust, right? Like, if people, I mean, that's basically like the strategic branding of companies. They use colors like blue because blue is a trust color.
Yeah, correct.
Yeah. So, yeah, that sounds perfectly reasonable. Would anybody else like to jump in, give their 2 cents on this particular matter?
The 2 cents.
Would anybody else like to weigh in on this particular matter?
I would agree with everything that Piers and Hans have articulated.
Yeah, same. I think, especially back to taking a look at smart contract risk and audits is probably one of the most important things when you're thinking about pitfalls. Yeah, it's been an interesting trend recently to see more token communities around DeFi develop around the concept of this fair launch. And so you saw that with stuff like Yam and Wi-Fi. And this is developing a community of investors where people need to do some work to contribute to the code and be a little bit more technical, I guess, in order to participate. So you get this pool of participants that are at a higher bar technically. They have the capability to do some of this, do your own research and really get into the code and look at, if something has been audited or not and things like that. So yeah, it's definitely interesting. And I think it's a difference from when you look at the 2017 ICO boom, where a lot of these token projects were being marketed to people that were just very unsophisticated. You didn't need to know much to click and buy some tokens with Ether. So yeah, I think with that, you'll see some losses and bugs with some projects because it requires this higher level of sophistication, but I'm definitely excited to see just in general a more knowledgeable population playing with these tools right now. Yeah.
I think
Okay, so
maybe just to chime in here, one thing that should be important to note is no amount of audits. Audits are are not the be and end all in this industry. I mean, you can have 5 audits and you could still have a bug. I mean, unfortunately, until a system is out in the wild and there's value at stake, you're really not going to fully, I mean, there's a Lindy effect in systems, right? And so these things take time. And so to your point, Hans, I mean, you can't trust an audit. You can't trust anything, really. You have to do your research, but even assume that there is going to be some level of probability that there is a bug in the contract. And so I think there are, you know, if you're really not very well versed in understanding a contract and understanding reading solidity, you know, I think you're better off just assuming that there could be a hack, there could be a loss of funds. And so, you know, plan accordingly, right? Don't put your life savings in there. These are experiments, is how we think of them. And if you frame it like that and go into a particular protocol thinking that it's, you know, the expected value could be 0, then, you know, I think it changes the mindset of how you approach investing in the space or getting exposure to these protocols.
Just to add one more thing that someone in the comments has said, which I think is really important, is rug pulls. It's a concept that people talk about in DeFi a lot at the moment, which is when, so for example, when we launched our token on Ethereum, we seeded Uniswap with some liquidity, and that's often a thing that teams do to make sure that there's liquidity in the pool so that people can come and buy and sell. Now, what we did is we went and locked that in something called Unicrypt, which means that you can't pull the liquidity out. But what has happened, and like Sushi's the best example of this, is they build up the liquidity, the number of people like putting their money into a project, and then they pull all of their liquidity out, which means that they manage to make a load of money from doing that, and everyone else suddenly has a much less liquid protocol that they can actually sit in. And because DeFi protocols run on liquidity, like the fundamental way in which anything moves in DeFi is as a result of things like continuous function market makers or automatic market makers, and that relies on the community providing liquidity. If you can't see that the team has made sure that a rug pull can't happen, or by locking tokens, by locking LP funds, all this kind of stuff, then you've got quite a high amount of risk just from the team coming in and being like, whoop, we'll take that.
I think I've already had 3 simple parameters. One of them you talk about, Piers, is there a time lock that the team has? Is the contract a fork or bespoke? There's fairly well tested staking contracts from Synthetics and Compound, or governance contracts that, you know, you're very easily able to compare, right, what has been changed. And the third one is the price feed, which some folks have talked about flash loans. I think where you're pulling your price feed is critical. I mean, most of these flash loan attacks recently have been around, you know, on-chain price feeds. And so I think it's important to recognize where the price feed is coming from, because that can be easily manipulated on-chain through flash loans. So, I mean, these are 3, but obviously, I guess the 4th dimension would be understand where the yield is coming from. Because if you don't, then you're probably the yield. So, you know, just kind of understand how yield, or the Ponzonomics, if you want, like how's that working, is important.
Okay, we got some great quotes in there. I'll tell you that right here. I like that one. Understand where the yield is coming from, because if you don't, it's probably you. I don't know if I quoted you verbatim, but pretty close, right?
Yeah.
Okay,
yeah.
Great.
That was good.
Okay, so as investors are, you know, evaluating different projects in this space, what key strategies should they leverage?
Sure, maybe I'll start. I mean, we think about this a lot. You know, there's a lot of excitement going on. There's many projects in the space, almost shipping daily. And so I think the most important thing that we think about constantly is really finding the highest caliber teams, very technically competent, that can ship product, and then focus on core use cases, right? Because no amount of financial engineering, now that we're talking about yield, can solve for a crappy product. That just does not work, right? And so if you think about what Carolyn and the team are building at Keep, like there's a very clear use case for what for like a reason of existence for building that bridge, right? Of connecting something like Bitcoin to Ethereum, or Compound or Uniswap. Like these are products that you could see the product market fit. You could see the usage of these networks in real time and on-chain data. And that's the beauty of this space. You're able to monitor traction usage of these networks. And so so I think for us, it goes back to a fundamental kind of premise of investing, which is investing in things that users want and will use. And then you can start focusing on other sort of second order effects like or the token economics. Properly designed. What is the Genie Coefficient? What does a team own? What's their incentive to build? And some other components. But it really just starts from the core premise of, is what you're building actually has any real demand and usage? So that would be my sort of first parameter.
Okay, could I ask a quick question? You mentioned the Genie Coefficient. Usually when I hear about the Genie Coefficient, I mean, I know what the Genie Coefficient is. It's a measure of the inequality of income in a society. But are you talking about the Genie Coefficient of the people on the team? Or I'm not sure exactly what you're referring to.
Yeah, someone, I think it was Piers or Carolyn, mentioned this like proof of, like a fair launch distribution, right? I mean, I think what you don't want to see is 2 or 3 or 4 wallets or individual owners of tokens that control most of the network. A, it's quite centralized, and B, also understand the vesting schedule of those participants and what is their incentive to continue to build, right? In the case of Sushi, the developer anonymously, who is anonymous, could sell his sushi at any moment's notice. And when you would ask him in the Discord channels, he would never answer and be very explicit around what his strategy was around holding all this sushi. Lo and behold, he just dumped it, right? Yeah, and then returned it. But I guess it's important to understand like what are the incentives. I mean, there are very simple things in traditional finance that work, and one of them are long vesting schedules for employees, builders, investors, right? And so if you have skin in the game, and if you have skin in the game for a number of years, then that's always a good sign of commitment to building a product.
Okay, makes perfect sense. Okay. Let's see. Would anybody else like to weigh in on that channel? I mean, not that channel. Sorry, that particular question.
Yeah. Again, like I think that like many of the same rules, like just following on from what Santiago was saying, many of the same rules to assessing the fundamentals is the same, like looking at the team and how long they've been working on it, and also whether or not they have what their track record looks like, how long they've been working on, how long they stick with previous projects, all that kind of stuff. There has been a rise of anonymous projects, which makes that a lot harder to do, and generally, like I personally steer clear of those, just because of the problems that come out of not being able to identify people and then being able to just disappear at any point means that the project can die, but also you can end up getting rug pulls and all these kind of bad things. But also just doing simple research like looking on GitHub and seeing how much activity is happening on GitHub, how many developers are working on it, how good the code is, if you're able to code, looking at code quality, test coverage, all that kind of stuff is all good indicators of how thorough and diligent the project is being built. And also, like, if you, depending on how good a developer you are, like where things are being hacked and it doesn't matter, and where people are spending real time sort of developing the core principles. Again, like, are they rolling their own everything for no reason, or are they like borrowing from good projects and good ideas that have come before them? And then just diving into the economic side of things is essential in DeFi, because fundamentally these are running projects. Like, unlike what happened in 2017, a lot of these almost all DeFi applications are live and got money in them, and they have a life that starts as soon as the developers put them live. And if the economics hasn't been thought out properly, or the way that the game theory is going to work and it isn't thought out properly, it doesn't matter how good the team is, you'll still get a failure as a result. So, like, there's so many aspects to investing in crypto, but they always hit this nexus of economics, team, and and technology. And like, if those three things are solid, you're probably good.
Yeah, I think we've covered a lot of great stuff throughout this conversation in terms of investor due diligence. So I'll just add a couple of things. We've talked about token issuance and the Genie Coefficient and where tokens are being allocated and unlocked. But I think a step above, it's also important to look at actually like, well, what's the value accrual mechanism for the token? Is it a governance token? Is this something that people can use to vote and change and make changes in the protocol? Or is it a work token, a staking token? Is this something that acts more as fuel in a protocol? And there's a lot of different ways that you can look at those different mechanisms. And then the other thing that I'll just say is on the tech side. So we've talked about audits and security and the benefits of being more technical and being able to review code for yourself. But even if you're not a developer, there's a lot of things that you can look for. You can look for, is the code itself open source, or is it not visible or visible? I agree with Santi that being audited doesn't guarantee that something is safe, but the fact that something is maybe audited more than once is always a good sign. And then also you want to take a look at things like, again, I'll go back to centralization. Not to say that a project that has an element of centralization is inherently a bad project, but there are risks involved with that. There are also risks involved with being a less centralized project as well. So you'll hear people talk about projects having an admin key, so that can be the ability to start or stop a protocol or turn off different parameters. And so it's important to ask those questions about, okay, who can do what here? Is it just the team, or is once it's live on the blockchain, is it nobody can stop it? So those are basic technical questions you can ask.
If I might add on that, I think to me governance is more or less the crucial issue. So I agree with what you said, Carolyn. And governance, as long as there's a community involvement or participation in the governance, the structure of the governance, and also restructuring of the governance, I think that's a very important element for me in any DeFi project, which more or less boils down to transparency, which results ultimately, hopefully, in trust. So, we all have our different triangles, and for me, the trust, governance, and transparency is an important triangle I always like to look at.
Okay, let's see. Okay, so at this point we've got a few minutes left. We've got about actually it's more than a few minutes left, but it's less than 10. So another question I have is, what key steps should investors take when performing due diligence on DeFi projects? I know we've already gone over some of this. So if there's anything in particular you'd like to add, feel free to do so. Okay,
well, let me start then on this one, if I may. Well, when it comes to auditing for smart contracts, for instance, well, not everyone can do that. I can't. I'm not an expert in that. And a lot of people, obviously, if we advocate do your own research, there is this point in time that you need to acknowledge your own limitations in that. And I certainly have my limitations in this, and it's a fast-moving area we live and we work in. The landscape is constantly changing. The product portfolios of services offered is constantly changing. So doing your own research is in that sense also almost a mission impossible. So you need to have help. And I think, someone mentioned Discord or Reddit or Telegram. There are lots of groups actually de-threading, code by code a project. Join them, listen, talk, engage with community to get an involvement and a better understanding. It's not, there's no shame that you can't necessarily do all the research yourself, but at least reach out to people that can actually help you understand things. So, the power of the collective in that sense is definitely something in my view, you should engage and embrace.
Yeah, that's some great guidance.
Oh yeah, and obviously always, it's a bit of a cliche, but not your keys, they're not your coins. Always keep that in mind.
Okay. All right, let's see. Would it make sense for us to take some questions from the audience at this point?
Sure.
I mean, I know we have some questions in the chat. So, let's see. There's quite a lot of questions here. So, I don't know, could somebody on the Sologenic team maybe point out questions that stood out to them as being great? Here we go. Somebody mentioned the term Ponzi-nomics. So that's actually a pretty funny term. Santiago, I believe you were the person who mentioned Ponzi-nomics.
Yeah.
Would you like to flesh that out a little bit?
Yeah, I mean, I think it's, it was half jokingly, right? I mean, there's token economics, and then there's, and just understanding, what I meant by that is just understanding kind of goes back to this yield construct, right? I mean, what is the inflation schedule of a token? What is the token distribution? What is the vesting schedule? There's different pools for certain farms, if you will, like pool 1, pool 2, pool 3, just understanding, some of these concepts are not as easily understood, but I think it's important. It goes back to the prior question around diligence. What are the, and Carolyn brought this up too, is like, what is the value accrual for a token? What is the usage of the token in the system? And I think, oftentimes when you start digging into how these things are designed, then it becomes, it can raise certain flags that it will become kind of readily apparent that there's either no value accrual or very strong value accrual, or there's not very clear token vesting schedule for the team. And that's what I meant, really. I mean, oftentimes you see these opportunistic, in any market, not just crypto, right? I mean, you see teams that are just opportunistic and can launch a project, spin it up really quickly. And again, it's just a healthy skepticism always goes a long way in this space, right? If the yield is 10,000%, well, you ought to understand how that works and what are the risks there, right? I mean, there's a reason why, generally speaking, there's some correlation between higher yield, higher risk, right? And so just understanding that, right, is important. Is all I meant by that. So it's just a healthy reminder of if it feels too, excuse me, if it feels too good to be true, then probably is.
Yeah, no, that makes perfect sense. I like the description of healthy skepticism. That sounds pretty good to me. I mean, you don't want to be too skeptical because it'd be hard to get anything done.
Yeah. No, look, I mean, we play around a lot with these systems like YAMs, and these are great economic experiments. Like, they're fascinating, really. I mean, I personally think that chapters in game theory and economics will be written for some of these protocols, even if they don't exist. Like, it's just actually pretty novel incentive structures that are being created on the fly and experimented. But they're just that, they're experiments, right? So if you're going to put your life savings on YAMs, you sure as hell better know what kind of contract and how it works, right? And so it's important to just, generally speaking, approach it as an experiment and use funds as if you're going to Vegas, right, for a weekend. Like, that's typically how, if it's going to be a massive success, then even a small amount will go a long way. But just it's important to approach it as an experiment, right?
I think that's one of the beautiful things about DeFi for me is this. You can experiment with small amounts of money. Like, if you look at the way that central finance works, a lot of the times you have minimum investment amounts. You have to get over a large number of hoops. With DeFi, you can install MetaMask. You can get a small amount of crypto, $100, $200, and you can play around with that to start off with. Yes, the fees are going to kill you on Ethereum because Ethereum doesn't scale and there's all of these problems, and that's why we built Radix. But from the point of view of the average user, yes, you can go and play with a small amount of money in any of these projects, any of these products, and like DeFi, you start getting it by just getting your feet wet a little bit. Don't be like, man, I'm going to put 20 grand in and it's going to be the first project I do. But like, there's nothing wrong with just being like, look, I'm going to see how this works as a user, put 10 bucks in and just call it a cost of experimentation. And you'll start to feel what feels right, what feels wrong, what's intuitive, what's not, how good the documentation is. But you can really only do that by diving in and getting involved. It's very much a user experience thing, not just I'm going to go read everything I can and then put it in. It's like trying to play a game just by reading magazines about the game. You actually have to play the game to understand how to play it.
Yeah, I agree with your comment there. It's definitely, I like to look at it as sort of a tuition. It's you lose some money, but see it as a tuition, and again, don't run if you can't walk. So yeah, I totally agree with what you just said there. Absolutely.
Okay, well, if nobody else has anything that they'd like to add real quickly, we pretty much are running out of time at this point. So I think I'd like to take a minute to thank everybody who showed up to attend and watch this panel, and I'd like to take a minute to thank everybody who participated in this panel, and I'd like to thank Sologenic for putting this all together. So thank you very much, everybody.
Thank you for having us.
Absolutely, it was our pleasure.
All right, have a great day, everybody.
Thanks, everyone.
Take care.
Cheers.